We saw opportunities in the South African bond market start to appear probably in the third quarter of 2015, and what really triggered it for us was when Nenegate happened, or what we know was the fire of Minister Nene in December of 2015, and the South African bond yield went from around 8.5% to suddenly to 10.5%. Suddenly there was massive high real yields in South Africa, and we said, well, this looks like a very attractive opportunity to buy South African government bonds, firstly because inflation was falling, the SARB was sticking to its mandate, and we're locking in high real yields with high liquidity. So we think this is a good opportunity for our investors. Initially, we started to buy in the front end to middle end of the curve, and later we shift to the longer end of the curve, where we still believe the opportunity sits for investors. Real yields above inflation became very attractive because we worked out that inflation, although it was going through a cycle, it would fall in 2016 and 2017, but the market was pricing for a very negative scenario and outcome in that first half of 2016. So we said, well, if inflation is going to fall and we can lock in high real rates into our funds, we think it will be to the benefit of our investors for the next 3 to 5 years. So that was really the value add for investors over that time. And what we've subsequently seen is obviously the SARB cutting rates as inflation is falling, the rand is going strong. It's a very favorable environment for South African fixed income, coupled with the fact that we're really in a low growth environment. And what that actually means is that there's not going to be a lot of inflation or demand driven inflation, because the consumer in South Africa is actually in a very poor state. So I think the SARB is less concerned around demand inflation. It's probably more worried about the rand and about the politics playing out. So it just looks to us that the SARB is going to have higher real rates in South Africa. It means higher short-term rates versus where inflation is falling. And we think this is a very good opportunity for investors and for savers over the medium to long term, locking in these rates above inflation at what we believe to be a very low level of risk. Well, I think good examples would be, firstly, if we look at the three curves, and there's three curves in South Africa. The first was the bank funding curve. We could lock in 3-year bank rates at 8.5%, 5 years in excess of 9%. That was attractive for us. The second example would be corporate spreads, where in good times banks lend at 1% over the interbank rates, and suddenly they had to pay up around 1.5% to 2% in the interbank market, and we felt at a low risk that was attractive. And obviously the more controversial one is government bonds, where in 2014 everybody said, well, why don't you own government bonds when yields were 6.5%, 7%? We said, well, that doesn't make sense to us. There's not enough margin of safety. And then when Nenegate happened and South African 10-year bond yields went to 10.5%, everybody said, are you mad to own bonds? We thought that was a great buying opportunity. So anyway, in this 8.5% to 9% on the 10-year yield, and let's say between 9.5% and 10% on the long South African bond yields, we think it's a good investable opportunity for clients over the medium to longer term. And those are typically examples how we've moved out of cash in our portfolios into these longer dated assets. Yes and no. So yes, the longer dated opportunities are definitely available, especially in government bonds. We feel the margin of safety is still quite wide in government bonds. Less so in the banking market, because banks play the market, and once they've seen this demand, they've compressed their spreads and they're issuing at lower rates. So it's not available at the moment in all the places on the curve, but on selective places on the curve. And what we've seen over the last 9 to 10 months is an incredible hunt for spread in the market, lots of demand for corporate paper. So where we were active buyers of corporate spreads over the last 2 years, what we're finding at the moment is less opportunity in the corporate market, because as I said to you, banks used to lend at interbank rates at 1.5% over in 5-year terms, and now it's getting closer to more 1.2% and lower, and we think maybe it's just not worth it anymore because there's less opportunity in that market. There's this hunt for yield. And typically, we would like to stay away from markets where there's a little bit of euphoria in market and very positive news. We'd probably go and look for more opportunities where there's unloved parts of the market. Well, we think the big benefit for our investors is that we've been able to lock in high real yields for our clients, so yields above inflation, without taking excessive risk. We believe that in the current environment where there's lots of political noise in the market and there's lots of fear, and prices are fairly low, we think this is a very good opportunity for our investors in the fixed income markets. So yes, that's where they benefit, high real yields at what we believe to be low risk environment.